I mentioned in the previous section that the ethical threats topic or the ethics topic has two basic topics within it or subtopics within it. The first topic was fundamental principles of ACCA's code of ethics that we covered in the last session, and now we are going to be covering ethical threats. Now the ethical threats are broken down into 5 threats according to the ACCA's code of ethics. The first one is self-interest, the second is self-review, the third is familiarity, the fourth is advocacy, and then intimidation. While we are going through these threats, you have to bear in mind that we are going to be doing examples for each of these threats. All of these 5 may be tested in a constructed response question or objective test case question. Therefore, students need to make sure that they not only understand this topic but have also practiced it so that they can manage both types of questions in the exam. We are first going to cover self-interest. Please remember that while the name of the threat remains self-interest, there are several examples of situations where a self-interest threat may arise, and I will encourage all students to go and review this topic from the notes and try and memorize the safeguards to the situations that may give rise to self-interest threat. In order to cover the self-interest threat, let's first look at what it is and under what conditions or under what circumstances does it arise. This is the threat that a financial or other interest will inappropriately influence the professional accountant's judgment or behavior. In easier terms, remember that for an auditor, the client's interest is of preference. So the auditor must protect their client's interest before any other interest. Self-interest threat arises in circumstances where the auditors are bound to think of their own interest rather than the client's interest, therefore giving rise to the self-interest threat. The first situation where a self-interest threat may arise is when an auditor has financial interest in a client. For example, having shares or owning shares of a client. In this situation, the auditor will not be able to detect errors from financial statements because the auditor will know that if these errors are reported, the value of their shares will be affected. Therefore, the auditor will give preference to their own interest rather than the client's interest, because it is in the client's interest to report all errors and fraud if there are any in financial statements. A safeguard for this threat is to remove the individual that has shares in the client from the team, because there is no other safeguard that reduces the threat to an acceptable level. So remember, any individual that owns shares in a client should be removed from the audit team. The second situation where a self-interest threat may arise is when the client offers gifts or hospitality to the auditor. Remember, gifts may be seen as an influence on the auditor's independent opinion. Remember, the timing of the gifts will not be important. Gifts may be offered before or after the opinion is issued. However, gifts cannot be accepted because they may be seen as an influence on the auditor's independent opinion. So, the first safeguard is politely decline the offer of gifts from client. However, if the gift is of nominal value, then it may be accepted. Nominal value gifts could be in the form of pens or souvenirs or notepads. However, even if the gift is of a nominal value, if it is given with the intention to bribe the auditor, then that gift cannot be accepted either. So remember, even in case of nominal value gifts, the intention has to be judged by the auditor. And if the intention is to bribe the auditor, then even nominal value gifts cannot be accepted. The next situation where a self-interest threat may arise is where the auditor depends on one client for a hefty portion of their revenue. So remember that undue dependence arises when the auditor may be unable to detect errors or fraud from financial statements of a client because they fear that if they lose the client, they will lose a hefty portion of their revenue. For this, the Code of Ethics suggests that gross recurring fee from one client should not exceed 15% of the firm's annual revenue. And if it does exceed 15% for 2 consecutive years, then the auditor should disclose this information to those charged with governance and conduct a quality control review before and after issuance of opinion. Now this is important. So remember that undue dependence is only made when the gross recurring fee for 2 consecutive years from one client exceeds 15%. Other situations where a self-interest threat may arise is when the auditors and the client have a close business relationship. Close business relationship could be in the form of a commercial relationship. So for example, the auditor could have a company in the auditor's name that is a major supplier for the client. Remember, auditors are not allowed to have commercial or close business relationships with the clients. So the safeguard is they're not allowed. And if a partner does own a company that is a major supplier for the audit client, then the audit partner should be rotated from the assignment. Another situation where a self-interest threat may arise is the offer of contingent fee. The word contingent literally means dependent on an event in the future. An example of contingent fee could be the offer of fee based on profit. Now remember, within this circumstance or within this situation, the auditor may be or may feel obliged to hide errors and fraud from financial statements in order to earn a higher fee from the client. Contingent fee, therefore, is not allowed, or contingent fee arrangements are not allowed. The auditor should politely decline the offer of contingent fee and inform the client that fee is based on the level of assurance provided rather than the level of profit. Another form or another situation where a self-interest threat may arise is when there is overdue fee from a client. Overdue fee may be seen as a loan to client or may be perceived as a loan to client. Remember, within overdue fee, the auditor may feel pressurized to hide errors and fraud from financial statements in order to recover the outstanding fee. Therefore, the auditor will give preference to their own interest, which is recovering the overdue fee, rather than the client's interest, which is to report on errors and fraud highlighted from financial statements. The safeguard is that if there is any overdue fee, the auditor should negotiate an acceptable and reasonable repayment schedule with the client. And in extreme situations, the auditor can refuse further services until previous dues are cleared. The next situation that could give rise to a self-interest threat is when the auditor is offered a director position at a client. Now remember, this position can be that of an executive director or a non-executive director. Remember, a threat exists no matter what kind of directorship is offered, executive director or non-executive director, because these are both positions of significant influence over financial statements and the business. Therefore, both of these positions, executive directorship or non-executive directorship, puts the auditor in a position where the auditor can serve their own interest rather than the client's interest. Therefore, accepting director position at an audit client while being an auditor is not allowed, not even as a temporary assignment. An auditor can only act as a company secretary that is not involved in any decision making at all if it is a temporary assignment. Another situation where a self-interest threat could arise is where recruitment services offered to the auditors. So this is a situation where the auditors may be required to recruit a non-executive director on the board. Now remember, this puts the auditor in a position where the auditors may choose a candidate that can serve the auditor's interest on the client's board. So if I were the auditor, I could choose a candidate that could serve my interests as an auditor rather than the organization's interest, therefore giving rise to the self-interest threat. Now remember, recruitment services are allowed. However, the auditors can only help shortlist suitable candidates, but they cannot make the final decision themselves, and they cannot negotiate with the candidate on behalf of the client or the organization. Remember, recruitment services are only allowed for positions that do not exert a significant influence on financial statements. So if the recruitment is of a finance director, then those recruitment services are not allowed. But if the recruitment services are for a non-executive director, then they are allowed only if the auditors can help shortlist suitable candidates and not make the final decision themselves. Another situation where a self-interest threat may arise is when auditor enters into employment negotiations with an audit client. So I could be an auditor serving XYZ company's audit. An XYZ company may offer me the role of finance manager. This is the offer of employment or employment negotiations with the audit client. If I've been offered a position at the client, I may feel that I need to hide errors and fraud from financial statements because I don't want that offer to be withdrawn. So I'm going to give my own interest preference over the client's interest, giving rise to the self-interest threat. An appropriate safeguard, therefore, is removing the individual from the team that has been offered an employment and a quality control review of the work performed by that individual till date, therefore reducing the threat that is associated with employment negotiations. These were some of the examples of situations where a self-interest threat may arise. Remember, details of these examples along with some other examples are given in your notes, and I am going to advise all of you to go through the notes in detail and try and memorize as many safeguards as possible to these threats. Let's go through an example. The finance director has informed the auditors that once stock exchange listing has been completed, he would like the engagement team to attend a weekend away at a luxury hotel with his team as a thank you for all their hard work. So this is an offer of a gift. In addition, he has offered a senior member of the engagement team a short-term loan at a significantly reduced interest rate, as the company specializes in the provision of loans and financial advice to individuals and companies. This is also an offer of loan at favorable terms, since a significantly reduced rate is offered. Now, remember, the gift, even though it is after the listing is complete may be seen as an influence on the auditor's objective opinion, therefore should be refused. And the second, the offer of loan at favorable terms may also be seen as an influence on the auditor's objective opinion. Therefore, loan can only be accepted if it is given on normal commercial terms that are offered to all customers. If the loan is to be given at favorable terms, then this loan A cannot be accepted, or the team member will have to be rotated from the audit of this company. So they will have to be removed from the audit team. So within one paragraph, you can see that there were two threats that gave rise to the self-interest threat. Remember, within the exam, a similar situation may occur. You may be asked to identify 5 or 6 ethical threats from one scenario, and out of these 5 or 6, maybe 3 or 4 may be related to self-interest. This could happen. Be prepared for such a possibility and answer these questions well. In the upcoming sessions, we are going to be talking about the exam technique of answering such questions.